All right, so today I wanted to talk about a company that I've talked about before, but I haven't talked about it in quite a while. And the reason for making this video is I think this is one of the companies out there that you can be buying right now. The markets are at basically all-time highs or within striking distance, depending on when you watch this. And I would say the majority of companies, well, the vast majority of companies, probably 95%, maybe even more, are either clearly overpriced or just not good companies that you shouldn't even consider owning. And this is one of the few out there that I think that you can be buying right now, and I'm going to get into why. So Skyworks Solutions, SWKS is the ticker symbol, $16.75 billion company, 2.5% dividend yield. Good company, right? They're in the semiconductor industry. They manufacture products related to that. So analog semiconductors are connecting people, places, things across new applications with the aerospace, automotive, broadband, cellular infrastructure, connected home, entertainment, gaming, industrial, medical, military, smartphone, tablet, and wearable markets. So again, they're fairly well diversified, which I really do like there. If we look at their earnings yield, I mean, it's a 5.1%. Free cash flow yield is 9.3%. So that's one of the many things I really do like here. If we get into the insights just briefly here, profitability, very, very good. I mean, an operating margin at 21%. That's very, very good. Management doing an okay job. Return on invested capital, 14%. Stock-based compensation is a little higher than you would like, but I don't think it's crazy. Growth has obviously slowed, but they're still projected to grow fairly well over the long term. Financial health is very good, which I'll get into. Again, they're projected to grow earnings 13% next year, although revenue is going to be down, so that's a little bit concerning. Dividend I'll get into later. Valuation I'll get into later. So let's dig into the financials here. So if we look at the balance sheet, just for starters here, debt is only $2.3 billion on a 16 and change billion dollar company. That's very good. So assets to liabilities, very good. So they do have a strong balance sheet, which again, with higher rates, it's very, very important. This is something that is not stressed enough. Revenue has, again, it came down a little bit, but again, we're still within striking distance of an all-time high. The trend is still clearly up here. If you look at earnings, again, similar story. This has actually trended down 2 years in a row, but again, I think that the trend is still up here. Obviously, there's going to be a little bit of cyclicality here. Shares outstanding, they've done a very good job at chipping away at this. They peaked out in looks like 2015 at about 195 million. They're down to 160, right? So they're buying back a good amount of shares every single year, which is good to see. If we look at the metrics, again, very important here to keep an eye on these. If you look at the free cash flow margin and the operating cash flow margin, those are both either at or very close to all-time highs. So this is one of the reasons why I'm not necessarily concerned here. I mean, operating margin 24%. That is, I mean, 34 looks like it's the highest, but I mean, 24% is still very strong. So I'm not overly concerned there. If we look at return on equity, return on invested capital, again, both of those are down from the all-time highs by a decent amount. But, I mean, 16%, that's still solid. That's nothing to be concerned about. If we look at free cash flow per share, arguably the most important metric here, again, this is easily at an all-time high. So when you look at the price of stocks over the long run, they're almost always going to follow the fundamentals. And when you're looking at fundamentals, free cash flow per share is pretty much the most important, if not the most important. So given it's at an all-time high, in my opinion, it's only a matter of time until that share price reflects that, or at the very least trends up. So that's very important here. If we look at the current ratio, like I brought up, it's over 3, so that's very good. If we look at the dividend here, again, this is one of the many reasons I like this company. Again, it's not crazy high, 2.5%, but they're growing it 10, 12% per year, which is exactly what I like to see. That consistent stair step higher, that's exactly what you want to see. The payout ratio, again, based on free cash flow, 27%. I'm not concerned about that at all. Based on the payout ratio, 50%, okay, maybe that's a little bit, but if they're going to keep growing anywhere close to what the rate they've grown, I don't think it's concerning. So the dividend, again, I very much like that dividend. So again, the big question here is, what is fair value? So again, let's get into it here. They have grown free cash flow over the last decade roughly at about 11% per year, roughly. But again, if you look at the last 5 years, they've actually grown faster. If you look at the last 3 years, they've also grown faster than that. So over the short term, they've actually been growing faster than the longer term. So, and if we look at the average price to free cash flow over that time, it's 22.75. It's currently at about 12. So that's significantly below that margin. Now again, 22.75, you could probably argue maybe that's a little bit expensive. It probably is. But if you plug it into a free cash flow calculator here, if we project they're going to grow their free cash flow at 8% per year, which is less than the 10-year average of about 11. They're not even going to buy back any shares, which they are. I mean, honestly, let's update that to maybe -1, which is, I think, if anything, that it's probably going to be -2 or 3. If they grow their dividend 8% per year and they trade for a 13 price to free cash flow, which is almost exactly what they're at right now. What are they at right now? 12. So that's slightly higher. But again, significantly below that historical average. Fair value is 132. I mean, even if we lower it to like a 10 price to free cash flow, that's basically right where it's at right now, almost exactly. So, I mean, if you put them at a 12, which is where they're at right now, that still means fair value is 15%, almost 16% above where it's currently at. So, like I mentioned right off the bat, this is one of the companies out there that I think you can be buying right now, and I would be buying it. I would not stop buying it again until it was around that 125, even 130. So obviously it's going to take a while to get to that. And even when it does get to that, you're going to want to redo one of these discounted cash flow calculators, because for all you know, that might not even be overvalued. So again, this company is going to have to be, in my opinion, it's going to have to be in the 130s, 140s, maybe even 150s for it to be considered truly overvalued. I mean, until that price to free cash flow, would probably have to get into the high teens, maybe even 20s. So until it's 18 plus, let's just say on a price to free cash flow basis, I would be buying. Again, just my opinion, obviously no expert here. So again, like I mentioned, the market right now, the NASDAQ, the S&P, all-time highs, vast majority of companies are overvalued. A lot of people are probably wondering, okay, well, what do I do? Do I sit out in cash? My opinion of that is no. You probably want to have a little bit more in cash than you normally have, especially with higher rates. But there's always going to be value somewhere in the market, and the question is finding it. I think this is one of the areas, or one of the companies out there that falls into that category. So anyway, if you like the video, please like, comment, subscribe, all that good stuff, and stay tuned for more.